Welcome. I'm Catherine Magana here with Rachel Ivanovich, Steve Wolf, and Vince Stefano. Here we are in the new year, 2024. We're going to share with you today some planning and a little bit about the markets and just kind of share some things that are happening. And I can't believe we're already in 2024.
Yeah, I was just still thinking about the Y2K issue.
That was a long time ago. Just kidding.
It seems like that was just like 3 years ago.
I just finished 2022 tax returns.
Oh, man. Well, that was like the forever tax year.
I'm always a year behind.
But as we reflect and as we look back now in 2023, we had an amazing year. I mean, it actually ended up a lot higher than we probably expected at the beginning of the year. Last year, we always heard recession in first quarter, then second quarter, and then eventually got pushed out. And we're still hearing, is there going to be a soft landing recession, or we're hearing, is it a Goldilocks economy? So obviously things do change. We do have a labor report coming out this week, which is everybody's keeping their eye on. Those are just some short-term things we think about and look at, but we do have a long-term vision. And when we look at investing, we also factor in, what the objectives and goals are of our clients. But I can't say we didn't have a good year last year. I'm happy to end on a positive note. But now we are just at the beginning of the year, and the markets are fluctuating a little bit already.
I think it's funny you mentioned what everyone was predicting for last year, and so few people got it right.
Yeah.
Which, I always have to laugh when people say, well, what do you think the market's going to do? What do you think this is going to do or that? And the truth of it is nobody knows. Yeah. Nobody really knows for sure what's going to happen in a short period of time.
Well, and it's interesting, you look at kind of the S&P 500 last year, it ended up about 24%, which was an amazing year. But throughout the year, it was actually down 10% at one point. And then you go back and look at 2022, where the S&P was down. And so it's just interesting and that's just an index, obviously, but that's one that everybody follows and knows. But if you try and time these markets, you can miss the market. And that's why I think, once again, you want to have good investments and strategies in place, but you don't want to be jumping in and out of these markets. And
the other thing is that last year was a good year if you were in technology.
Absolutely.
Which dominates the S&P 500 and that type of thing. If you were not in technology, you barely broke even.
Yeah.
So.
Well, it's interesting. I'm getting a lot of calls, at least recently. I think that the holidays, everybody was reading up, and everyone's, and we've talked about it in the past too, with the AI stocks, and everybody's, wants to be part of AI. It just seems like that's like the hot, AI 2.0 is coming.
Well, and right now, we're thinking about what's going to happen in 2024,
Yeah.
and will there be a recession? Will there not be a recession? Will we have higher interest rates, lower interest rates? I mean, I think that common sense here says that since the economy is slowing down somewhat, that rates have peaked and they probably will go down, but that still means we may not have a recession.
Yeah.
And that's always seems like we've talked about for almost 2 years now.
The recession that has never materialized. And that's what, and I feel bad for a lot of retail clients that probably have went to cash or extensive amounts of cash in their portfolio, and unfortunately missed a very good run in the market. And unfortunately, I've had one or two that were very frightened of losing all of their money, and they forced me to go to cash, much to my chagrin. And they missed a very good run. And I happened to be speaking to him recently. And, my comment was, listen, it will never happen again. I said, I will never take you to that much cash, no matter what you say to me. I said, you go find another financial advisor. I said, I'm just not going to do it. And I felt bad because, people had missed out on a very good run. And, you're talking about, rates and all that. And, we may have a rate cut. We may have 2 or 3 rate cuts, in which case, bonds may do quite well next year. I'm not sure. I'm not a bond manager. However, the problem with a lot of retail clients that I talk to or know, are in mutual funds. And unfortunately, most mutual funds, all they own is the NAV, and they don't own the bond proper.
The NAV meaning?
The net asset value. So if there is a standard deviation event and it does affect the market, it can affect both bonds and stocks at the same time. Oftentimes, your NAV will drop considerably and you say, hey, how did I lose money in the bond market? That's why I think going forward, I would not be a bond investor. I would more be in a high quality, dominant, rapidly growing companies that are looking to increase their unit volume growth. That way, if you do have any type of slowdown in the market, these companies still have internal growth engines to offset any slowdown. So look for those types of companies, and they're found readily in technology, healthcare, medical devices, energy, things like that. So I think that's where investors should focus.
Going back to the whether we're going to have a recession or not. Do you guys remember that little children's story, The Little Engine That Could? I think I can. This is the recession that could, the little recession that could. I think I can. I think I can. And this time, will it get up over the hill or not? I don't know. And by the way, going into bonds are never meant to be a growth vehicle. Okay, so in the long run, stocks have outperformed bonds, and that probably will be the case on a long-term basis for as long as we're around, as long as we have capitalism. But having a bond in the portfolio still isn't a bad idea for some of your money. If you don't want to put everything at risk. This way, you have something that you can get currently in the area. I don't know, 4, 5, 6%. That's not so bad.
I agree that you should own some bonds, but I think you need to own the bonds properly so that if something does happen, once they mature, at least you get your principal back, as opposed to just an NAV where you have to sell in an open market. And I've seen NAVs down 15, 20%. So people say, how did I lose money in the bond? So anyway, if you want to own bonds, I suggest you speak to your financial planner. Speak to your financial planner and own the bond properly. So if anything does happen, you get your principal back at maturity.
Yeah. So speaking about talking with clients, this is a good time. Obviously, we just finished the year. This is a good time for those of you that have required minimum distributions for 2024 and need that income. So this is a good time to kind of revisit that. So we are available to meet with our clients and go over their accounts and investments and if there's any changes with their financial plan. But one of the things to think about is there are some contribution limits. So for your IRAs and the Roth IRAs, there's also 401k limits changes, but in particular for IRAs and Roth IRAs, the contribution limit went up $500. So you can now put $7,000 if you're under 50 or $8,000 if you're over 50. So just kind of if you're making contributions, just something to think about making some updates to your accounts.
Yeah, these are all changes that the Secure 2.0 Act brought last year. So there's a lot of new legislation in 2024 that could change the way that investors are saving for retirement. As we may or may not know, the Secure Act, the original Secure Act in 2019, revised the existing rules for RMDs and eliminated the age limit for traditional IRA contributions. So in the past, once you hit a certain age, 70 and a half, you were no longer eligible to contribute to a traditional IRA. And so that was eliminated by the Secure Act in 2019. So the Secure 2.0 Act, which is supposedly better, if you are born between 1951 and 1959, you have until age 73 to take your required minimum distribution. If you were born 1960 or after, you don't have to take money out of your IRAs or your required minimum distribution until age 75.
That's amazing, like all the differences and changes.
It
seems
really
like
is.
In the last few years, it's changed a lot.
And so I've had to have my little trusty notes here because it's hard for advisors, for us even, to keep up with all of the changes that are out there. But really, I think that Congress wants to encourage saving and saving more for retirement. And so clearly, we're here to help support that, but it's good to know, what the limits are. They have also changed the penalty for if you fail to take your required minimum distribution. It used to be if you failed to take money out of your IRA, then you would be penalized 50% of what that balance would have been. They've reduced that to 25%. So I think that's great for investors now to know if you failed to take that money out, make sure you get with your financial advisor and make sure that money does come out in 2024.
And then that ties into if you have an inherited IRA,
correct,
that you have the 10 years to take it out, but then now with the new rules and everything got pushed back. If there was a requirement distribution being taken out starting in 2024, there has to be a little bit of money taken out of the account. So it's not just the 10-year rule. It's going back to look at the required minimum distributions.
Exactly, yeah. So yeah, if you inherited an IRA from I don't know, whoever,
Someone.
someone who was not your spouse.
Yes.
The rules are different. For spouses, the rules are different. So be sure you're talking with your advisors about those rules because they are complicated and it depends on how you were related to the individual who left you the money.
So what other rules have changed for the year?
So for 2024, one of the things is that if you have been saving money in an education account, or maybe you put money into an education savings account for a grandchild, and maybe you've overfunded it, the money grew, and all of a sudden, or maybe your grandchild or your child decided to not go to college, you can, starting in 2024, I think this is really great because a lot of people are afraid to overfund their education savings accounts. So this, the logic or the rationale behind this, I believe, is that if there's money left over starting in 2024, you can move $35,000 from an education savings account to a Roth IRA. So the $35,000 is a lifetime limit, and each year you can move up to the annual Roth contribution limit from the 529 or the education savings account to your Roth IRA.
So it would be approximately 7,000 based on today's
7,000,
numbers.
correct. So you can do that
right.
over 5 years in order to get the money out of an education account into a Roth for that beneficiary. So it's not just stuck sitting there in the education savings account forever if they decide not to go to college.
You got to wonder who thinks up all these rules.
Believe me, they come up with some really odd things where you wonder, I wonder who in Congress was having a situation where they needed this rule.
I think this is just to keep accountants in business forever.
Oh, absolutely. Yeah.
I'm still waiting for them to just say we're not going to tax all your money except for maybe 10%, and then
Well, I have to look up the new standard deduction every year. They just released the new standard deduction for the year, which is indexed for inflation. The standard deduction is up 5.4% this year, as are the tax brackets.
So what does that mean? So let's say you're in the 25% tax bracket.
Yes, sure. Okay, so we're in the 25% tax bracket. Basically, what that means is, so tax brackets are progressive. That means the amount of money that you can earn that's subject to that tax rate has increased by 5.4% for the year.
All right. So if just for example, if $100,000, and I know this isn't the case, if $100,000 was the limit on that bracket,
Correct.
it's now $105,000 and change to be in that
Correct.
same bracket.
Yes. So you
Okay.
can make a little more money and still
You
save.
have to make this simple for me.
Okay, thank you for clarifying it for me too. And gift tax has also been indexed for inflation. So the amount that you can gift to an individual has risen from $17,000 to $18,000 for 2024. So that's, I think, is a
I'm telling you, you've got to be have an IQ of 140 just to keep up with this stuff. You know, speaking of that, I just reading about this 6-year-old who is now one of the youngest members of Mensa, the newest member of Mensa. He's 6 years old. That's scary. It really is. And he's not the youngest either. I think the youngest was 3 years old.
interesting.
And they can't figure out these rules.
I have to look up the numbers every year. But health savings accounts have also been indexed for inflation. So if you do have a health savings account, the amounts that you can put in your health savings account has gone up to $4,150 for 2024. I think that health savings accounts are great vehicles.
Why?
Because I have a lot of clients who call and ask, can I write off, I had, this procedure, or I had to get braces for my child, or I don't know, they had something and they want to write off their medical expenses, but it's really hard to write off medical expenses because first of all, you have to itemize your deductions. Second, any of your medical expenses, before you can deduct the first dollar, those amounts have to exceed 7.5% of whatever your adjusted gross income is. So you have to be very sick or dying, basically, to write off medical. So
most of the people then in Congress ought to be able to do that because most of them seem like they're about the age of dying, right?
So a workaround for this is the health savings account.
Which you don't have to use all of it every year, so you can save it.
Correct.
Right? You
So the way that it works is you have a high deductible medical plan that you are a participant in. And you can put up to, if you're individual, $4,150 annually. It can grow tax deferred, and it comes out tax free later if you use it for qualified medical expense, which includes dental, includes vision, chiropractic, alternate medicine.
So we're going to have a quiz for all you people who are listening, and we're going to have a quiz after this, and you're going to have to tell us everything that Rachel just said. I'm glad you're on our team
I
be
love
honest with
doing
you.
taxes. It's so much fun.
You're sick.
I can't believe it.
People have told me
I love
that
how
for
all this
years.
ties into financial planning and everything too. So
But going back to the markets for just a minute here, because I know I'm riveted by all the rules, but
There's so many more. I'll keep.
but
we'll save it for next time.
But going back to the markets, I think last year was a perfect example of why you don't just get out, which is what Vince was saying before. It was very logical as to what happened in the market last year. All right, when interest rates went up, bonds went down, value stocks that were more dividend oriented went down because it's competition. Once the Fed said, hey, we're going to pause, and more than likely people are saying, because the economy is slowing down, that they're going to stop raising rates and probably lower rates here in this year, well, that's the signal for people to say, okay, now it's time to get back into those things that were down. All right? And that's what happened. Now, why in the beginning of this year, this week, okay, the first couple of days of the year, the markets were down. Why? Well, it's really pretty simple. It's because at the end of last year, there were so many gains that people didn't want to take because of taxes, right?
Exactly.
And so they waited until this year to say, okay, now I'm going to sell some of these things that have been high because now I don't have to worry about the taxes for another year and 4 months. And you have all year to take losses against that. So all this is very logical, but people get way, way, way too emotional about the markets. And it's like, Vince was saying here, he had a couple clients that wanted him to go to cash, and I guess you did. And it's just a mistake. And this is something I really, really wish anyone who is an investor would take to heart, that the markets long term do fine, and rarely does it happen that when you're down a lot in 1 year, you're going to be down a lot the next year. Quite honestly, it's usually the opposite.
I agree. The first couple of days of the year can either be very good or, as we've seen, not so good. And typically what happens the first part of the year, people start funding their 401ks, lots of money come into the market, and people start buying stocks. This year, first thing that happened, rates ticked up. And we've seen probably a 35 basis point jump in the 10-year bond rate, which affects everything. It affects bonds. It affects stocks. Again, people are coming off 9 weeks of incredible gains in the market, and you're going to see some profit taking,
especially in tech stocks, which are the things that got sold off here in the last few days.
Yeah, and I think you'll probably, and people are now looking at, fourth quarter earnings and saying, hey, what's Q4 going to look like, and are we going to be able to sustain these types of multiples and valuations on these stocks? And we'll see. It could be choppy. I expect that, over the next I expect this quarter, if all goes the way I think it may, the S&P may chop around between, +3 and +5%, and, kind of muted.
Yeah, what I'm hearing is it's going to be a little volatile until the
I
spring
think
and then
it's
towards the
gonna
end
be
of the
muted,
year.
yeah.
But we don't know. We don't have the crystal
I know.
ball, but that's
I
what we're
know.
seeing.
But I'm not getting.
I will tell you, though, that the companies that are in AI that can figure out a way to monetize it over the next several years are going to do very well. It's happening. It's not something that's a pie in the sky type thing.
Especially with minimum wage keep going up and everywhere, and just there's companies that have to find ways to continue to have their business in place and not have the costs from labor.
Right. Well, labor costs has been a lot this year, and it's funny too because if you look at it, even though like minimum wages are going up, it's still not keeping up with the cost of living.
Yeah.
So it seems like you're making more, but you're really not because the economy really has slowed down right now. And businesses, it's a lot tougher to make money when your expenses keep going up. You got to figure out, well, what do I do? And that's where AI actually is coming in. I look at companies like the fast food businesses. It's already happening where you go in there and you see the kiosks. Okay, at some point, I think there's going to be robots that are going to take over.
So it's interesting. I don't do a lot of fast food, but with the kids in their sports, we ended up going through a fast food restaurant a couple of weeks back, and there's to take the order. The actual order was AI. It wasn't a live person. It took a little bit longer just to get the order in.
Was it a kiosk?
No, it was the drive-through.
Oh.
Yeah. Okay. And so it was like, oh, here. And then who knows what they have in place inside. But it was just interesting but I have to admit, it wasn't as fast. Like usually you go through a fast food drive-through, it's like you're expected to be quick. It took a little longer, but I think eventually they're going to get this down.
Well, robots are the future. I mean, if we can find some really great companies that make the robots, that could be a place to invest. Who knows? But there's always something that's going on. But in order for a business to cover the costs, they've got to figure out something. And in the fast food business, I think they've already figured it out. There will be robots. There will be kiosks. There will be less people working there.
I even saw some innovation about a kitchen having the AI doing, starting to do meals and things.
The
in
cooking.
Yes, the actual cooking.
That's perfect for you.
Yeah, exactly. I need one of those. Sign me up.
All right. Well, this, I think, is a wrap for this week, and I'm glad we could talk about it, and we'll be back again next week and talk about what's happening in the markets.
Great. All right.
Please stay tuned for important regulatory disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Wolf Wiese Magana, LLC, doing business as WWM Financial, Savvy Doc Financial Planners, and Savvy Woman Wealth Management, is a registered investment advisor with the SEC.